inflation is front and center now. Everybody's talking about it. The biggest conversation is, how it's impacting the stock market if you're not impacted in other ways, about future rates and real estate, mortgage rates. But I will say this, those that are market predictors and really engaged financially have been aware of a future inflationary environment. And I think all of us who pay attention to anything have kind of seen some of that dialogue, some of that language, and they've been prepping for the moment of inflation. And that's clearly one of the biggest reasons real estate has been so hot in the last year and a half, where everybody expected it to taper off at COVID. Everybody went, wow, big injections of cash into the economy globally to attempt to create stability. But those that are financially aware, we're clearly on the predicting that there would be future inflation. And now it's happening. We have stats looking back, and that's why everybody's talking about it now nonstop.
Yep. Okay, well, let me get into it. This comes from our friends at Mind, spelled MYND.com, and they look to be really an investor site for real estate. So they definitely have their pulse on this constantly to help their clients. And it is what it is. With inflation running hot, real estate is a refuge. So Federal Reserve Chairman Jerome Powell has passed through the 5 stages of acceptance about inflation. Originally nominated to the Fed in 2012 and named chair in 2016, Powell and his colleagues kept rates low and growth was steady, if unspectacular, as the economy gradually recovered from the hangover of the 2009 housing crisis. Inflation, the rise in prices for goods and services over time, bumped along well below the target rate of 2.5%. And life was mostly good at the Fed. When the pandemic hit, the rate fell near zero, but has been on a near steady uptick for the last 22 months. At the beginning of 2021, Powell and his colleagues at the Fed were calling inflation transitory and were confident prices would soon moderate. In late summer and early fall, Powell used words like elevated and a cause for concern as the rate moved above 4%. By the end of November, Powell was acknowledging the obvious. Prices had soared 6.8% year over year last month, the fastest since 1990. And he said it was time to retire the term transitory. And Darren, I just noticed this was actually written December 17th, 2021. So yeah, it's only gotten worse, I think. By December 15th, Powell was in full acceptance mode. Economic developments and changes in the outlook warrant this evolution, Powell said of the Fed's decision to pull back on bond purchases more quickly than planned and target 2 to 3 rate hikes for 2022, perhaps 3 more in 2023. Let's see. Concern about jobs drives Fed policy. All along, Powell and his colleagues at the Fed expressed their concerns about the job market, and were reluctant to make any moves that would prevent the economy from reaching a full employment. The unemployment rate was 4.2% in November, down from 11.2% in June of 2020. Frederick Mishkin, a Columbia University professor and former Fed governor, believes that the economy has already reached full employment and the Fed was much too optimistic on the inflation front and were distracted by their focus on the labor market. Mishkin's fear is that the Fed will have to raise rates higher than they would otherwise needed if they had acted earlier. The Fed is behind the curve, Mishkin said in an interview with CNBC. The reality is inflation is higher than they anticipated, and it's more permanent than they anticipated. Mohammed El-Erian, president of Queens College, University of Cambridge, and a professor at the Wharton School of the University of Pennsylvania, wrote on Project Syndicate that there is still time to avoid a painful bout of prolonged high inflation. But the Feds need to do 2 things. It should publicly detail why it got its inflation call wrong and what is being done to avoid similar slippages in the future. Second, the Fed must move a lot faster in tapering its monthly asset purchases, easing its foot off a stimulus policy accelerator that is still essentially in a pedal to the metal mode, will help to mitigate the risk that the Fed will have to slam on the policy brakes in a disorderly manner in mid-2022. All right. How is real estate a hedge against inflation? Investing in real estate offers a couple of advantages during inflationary periods, and this recent run-up is no exception. And there is scads of evidence that a diversified portfolio, one that has 20% or more invested in real estate, offers strong and stable returns. Doug Bryan, the CEO of Mind, believes an inflationary environment creates more opportunities for investors in the single-family residential market. It's an attractive option because rents are bound to rise along with inflation, Bryan said, which increases the cash flow for property owners. With rates poised to rise in the next year, demand for rental homes is likely to increase as well, he added. If it becomes more expensive for potential buyers to finance a purchase, fewer will be able to afford it. This will increase demand for single-family homes and create more upward pressure on rental prices. Go ahead.
Pause there, Joe. That's a lot to digest, but
yeah, it's a dense article overall.
It is, but we'll obviously we provide that. People can go back and reread it. We'll provide that link, but this is really important to grasp. So, increased opportunities in buying on the single-family side from an investor perspective, which creates more competition from an owner-occupant purchase perspective, and then inevitably, an increase in prices will increase rents. That's a very interesting thing. Now, there's an issue with rent control and rents are frozen, but certainly when vacancies come up, and we have a client who's been out there trying to find a little 2-bedroom, 1-bath with a private yard, and it's almost impossible. I mean, the competition in the rental market for good rentals is almost as tough as it is for sales. So as prices continue to rise, we had a lull in the multi-unit environment for quite some time during the pandemic in 2020. But we're beyond that low, and those prices have become quite strong on the multi-unit front, and they will be expected to continue to rise as well, along with the single-family homes.
Mm-hmm. So the old adage is that real estate acts as a hedge against inflation. And there are a number of reasons for that, including, number one here, housing prices rise with inflation, so owners will see appreciation. With the housing shortage so acute, longtime owners have already seen their assets increase more quickly than at any time in recent memory. Prices will likely moderate, but increases of 6 to 9% in many markets are expected. That's one.
Yeah. And, so if you need to push the limits, sometimes we're never one to try to push people to uncomfortable zones. But certainly those that can afford something, the numbers work, it pans out for them. Those who have decided to jump into the market have benefited. And looking forward with inflation, increasing prices and stability in the price increases, sometimes people might have to push a little outside of the comfort zone at this moment, which will hopefully stabilize in the future, as it has for those that have purchased in the last year.
Right. Okay, mortgage payments do not change over time, but inflation means the money paid back in the future is worth less. As equity grows, fixed rate payments stay the same. Anything there?
No.
Okay. Rents on single-family homes have been on a steady upward swing over the last year. CoreLogic reported that September 2021 data showed a national rent increase of 10.2% year over year, and inflationary pressures will hit the rental market as well. Wow, how much more? Goodness.
I
know. It's amazing. Do mortgage rates correlate to inflation? Short-term inflation generally has little impact on mortgage rates, which are more closely linked to the 10-year Treasury bill, where rates tend to rise slowly. And when the Fed increases the one rate it controls, called the federal funds rate, mortgage rates are more likely to fall. That is because the interest rate that Fed controls is what banks and credit unions use to lend to each other overnight. This is a very different lending market than the one for mortgages, where banks compete with one another for business.
Now that was, pointed out in an event we went to last week. Probably one of the most important things to understand about mortgages and increases in the Fed rates going forward. The opposite typically happens. If the Fed continues to increase, there's actually stability in the mortgage market because short-term cash becomes more expensive. But the 30-year fixed rate mortgage is based on a longer-term treasury bill.
Right. So 30-year mortgage rates reflect what the market thinks rates will be over the next 10 years, said Dennis Braun, Vice President of Growth for Mind. People don't expect 6% inflation to last the next 10 years. Many forecasters expect that next year consumer prices will land closer to the Fed target of 2.5%. The phrase historically low has preceded mortgage rates in thousands of articles about home financing over the last couple of years, and that is not likely to change in the next year or so. The 30-year mortgage rate is just over 3% now, with investment mortgages available for about 1 to 1.5% more. But now that the Fed is going to cease its asset purchasing programs earlier than planned, rates could see some upward pressure.
Right. We've already seen that.
Yeah.
This article was written a month ago. Yeah.
Right. As they start tapering, we'll see how much quantitative easing is affecting rates, Braun said. That's a bit of an unknown. So, yeah, as you're saying, it's appearing now. If rates for primary residences rise, the impact on borrowing for investors in the single-family residential sector is softened by the fact that they're already paying higher rates than those buying a primary residence. Owning property brings with it numerous benefits. Even in this crazy environment, it's still a relatively safe investment, Braun added. Single-family SFR investors earn cash from collecting rent, and owners who buy and hold are able to employ several strategies to reduce their tax burden, writing off many expenses associated with the rental property and taking depreciation on a home. Housing markets rise preceded inflation surge. The run-up in prices in the housing market started before the inflationary pressures of the last year, as a shortage of homes and the pandemic-fueled migration to the suburbs and smaller cities spurred bidding wars and double-digit percentage hikes in many cities. These increases are hitting families looking to buy in the single-family residential space, as well as investors, a group that now includes some deep-pocketed institutions like J.P. Morgan, Blackstone, and the Toronto-based investment firm Tricon Residential, which plans to invest $5 billion in single-family rental homes in the U.S. in partnership with Teacher Retirement System of Texas and a Pacific Life Insurance company. A lack of inventory is really jacking up home prices, said Don Ganguly, Senior VP of Mind Investment Management. With investors forced to pay higher prices because of the increased demand and the looming increase in rates, they are, quote, not getting as much juice month to month with cash flow. The cost to build homes has risen dramatically in the last 2 years as lumber prices went through the roof. Literally, they were 4 times their normal price in May, and at one point were said to be adding $36,000 to the price of a house, even as a labor shortage and supply chain issues plague many developers. A semblance of normalcy is starting to settle over the housing market, part of the seasonal slowdown as winter approaches. Though prices are still high and going higher in the hottest markets, like Atlanta, Phoenix, Raleigh, Charlotte, and Austin, most forecasters predict high single-digit increases in home prices in 2022 across the country, as opposed to the double-digit jumps of the last year or so. For those already in the SFR market, these have been heady days indeed, and many experts believe that there are still good opportunities if investors do their homework and find properties that have potential. Rental housing demand is going to continue. Some percentage of people are going to work out of their houses for some period of time. A lot of these people may not want to buy, so you're going to have a spillover from the apartment rental cohort who are looking for a home in the rental market. So, wow, double whammy there.
Yeah. So, one of the a lot of the opportunities that people are taking advantage of in California, in Los Angeles specifically, obviously it's the market we're in that we see, is ADUs, seeking single family homes that have an opportunity to expand on ADUs, even building out ADUs on their existing homes that they're already there as an expansion of living opportunities or extended family. It's just happening consistently these days. So that's definitely, we're getting more housing inventory. Prices continue to rise. I'm going to be very interested to see later in the year how they talk about migration trends through LA based on the cost of living here. And we'll see where all that ends up happening. I believe we had an exit last year. So we lost more people than we gained in our city here.